Good day, everyone. My name is David Williams, Executive Director of the United States Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled COVID-19 Impact on North American Oil and Natural Gas. We are very grateful to our moderator, Dr. Sam Van Vactor from Economic Insight, and our distinguished panelists for today's timely discussion. First, a little bit about the United States Association for Energy Economics. We are the largest affiliate of the International Association for Energy Economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations along with a host of other products and services that you can find at our website at www.usaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those who cannot participate in today's live event. If you have questions for the panelists, please click the Q&A button at the bottom of your Zoom window and type your question. We've allocated sufficient time at the end of this webinar to address your questions. And now I would like to introduce you to our moderator, Dr. Sam Van Vactor, President, Economic Insight. Sam, over to you.
All right, well, thank you very much, Dave. It's really a pleasure to do this webinar. It's timely as well as, I hope, fairly significant. We've got a lot of different things happening in the energy industry right now, especially in oil and gas. And so we're going to focus on that for the next hour. I want to make a couple of brief comments about COVID-19 before we get started. I've followed this since it began, and what I initially learned, there was a report by Imperial College here in London that suggested that there could be up to 2.2 million deaths in the United States. That was followed by a report by the University of Washington, IHME, that had deaths in the United States at 67.6 million. I'm somewhat disappointed to report that as of today, we've already met the University of Washington projection. So we know it's going to be substantially higher than 67 million deaths. It leaves us with a great deal of uncertainty. And that uncertainty is impacting the industry, and we're going to hear a lot about it. I think we'll start right off with Ron Ripple here, who's going to talk about what happened in Oklahoma during the April 20th, and we'll turn to either Les Demand or Jeff Curry as soon as he gets on, and we'll hear the rest of the story. Okay, Ron, take it away.
Can you hear me now?
Yes.
Okay, I think I'm unmuted now. All right, great. Okay, I'm going to step through a few things here. I'm going to start my outline. I'll also give a summary, given that we have abbreviated time here, so that in case we run out of time, you get my sort of summary points. I'm going to take a look at whether or not the negative price for crude oil was rational, the role of Cushing, Oklahoma storage, evolving balances, evolving futures prices, and the question of any more negatives in the offing, the role of the Saudi-Russia price war, and then sort of as a wild card, a couple of comments about the possible role of the Texas Railroad Commission. The summary is I believe that the negative price was rational given the conditions that were in place at the time, and we'll talk about that. I think only time will tell us whether or not, when we're going to come back into balance and at what price that balance will occur. And the combined uncertainty from the demand shock imposed on us by the pandemic and the continuing uncertainty about the timing of production responses in the United States lead us to sort of an extraordinary overall uncertainty for the near term. but I do think that there's a reduced likelihood of there being another negative price episode. All right, so for the negative price, given the market conditions that held, I need to do that. Okay, given the market conditions that held at the time, I think that the negative price was rational. The final day of trading for the NYMEX May 2020 contract was set for April 21st, but at the opening of trading on the 20th, the open interest in that contract still sat at over 108,000 contracts, and that implies 108.6 million barrels of deliverable oil off of those contracts to Cushing, Oklahoma. The available storage at that time, based on what the end of week April 17th was only 16.35 million barrels. So at the opening of the penultimate trading day, the deliverable contracts represented 6.6 times the available storage capacity, where the norm, if you will, is more likely around 1.5 times. At the close of trading on the 20th, during which that negative price resulted, open interest was down to just 13,044 contracts, so that the deliverable oil was less than the available capacity. I have to understand that that available capacity was available in April, and we're talking about a contract deliverable in May. So there's a timing issue there, but you can see where the pressure was coming from. At the termination of trade on the 21st, open interest was down to 2,724 contracts, and that was quite normal for the way these contracts come to an end. So the negative price resulted from a fundamental storage supply demand imbalance, and that negative price corrected it, and it sent what I believe to be a rational signal to the marketplace. If we take a look at the capacity situation at Cushing, Cushing's capacity is at 76 million barrels as of September 2019. That represents about 15% of the total USA crude oil storage capacity, but it's effectively 100% of the capacity for the deliverables off of the NYMEX contract. And you can see by the steepness of, both the size of the stacks in the left-hand graph and the steepness of the incline of the levels on the right-hand graph, that this was a very unusual, and still is a very unusual period. The increase in storage over the 6-week period since March the 20th has been a little over 24 million barrels. That's roughly twice the size of the largest 6-week period increase during November 2014 to May 2015, when we saw a similar very large increase in relative steepness of increase for the fill, but this is still quite different. And at the end of last week, or at the end of the April 24th, there was just 12.7 million barrels of capacity remaining at Cushing. All right, if we just look at a shorter term view, week-on-week dynamics, crude oil stocks increased, but at a slower rate than and I'm focusing here on Cushing, but they increased at a slower rate than the previous 3 weeks. Finished gasoline increased in the US, but stocks decreased, and those stocks took up about 72% of the storage capacity. Domestic crude oil production decreased from the previous week by 100,000 barrels per day to a level of 12.1 million barrels per day, and that's down from 12.8 million barrels per day in February. These, I think, are all signals for the market moving more toward balance. Net crude oil imports decreased. They were down 47,000 barrels per day to 2 million barrels per day, and that's 58% below the same period in 2019. And we had our first fill into the SPR in about 2 years, and the SPR fill went. The increase was 1.15 million barrels. This news was all released by the EIA on Wednesday the 29th, and the NYMEX June settlement price increased each day through the end of the week, and it was up $7 over that 1 week period. Looking this morning at opening trading, it was off very slightly, but the entire curve was down, but the June contract was down less than the rest of the curve. The open interest for the June contract, June delivery, has been in decline, suggesting earlier recognition and acceptance of potential storage limitations. It was down 64,000 contracts during the week. Take a look now at the Saudi-Russia price war. A point I want to make very clear is that Saudi Arabia does not set prices. That's a misnomer in the way it's reported in the media. What they do is each month they announce a differential against regional benchmarks, and the 3 primary regional benchmarks are Oman and Dubai for oil going to Asia, ASCI for oil coming to the US, and Brent, the weighted average Brent price for that going to Europe. And if you note, the application of those is on a monthly basis, and it's announced a month before. So the April 20 discounts that we see there were set after the failed meeting in March, and that's when the price war began. And we can see that the very large discount of $10.25 was imposed into Europe, and a significant $3.10 into Asia. Those are the 2 primary markets for Russian exports. There was also clearly an increase in the discount coming to the United States. But if we then move to what happened after the April meeting, when in fact there was an agreement, I would say that the price war is not over yet, because again, these were set after the meeting. So after there was an agreement, the discount into Europe was maintained at 10.25. The discount into Asia was increased to 7.30, but the discount to the US was significantly decreased from 3.75 down to 75-cent discount. So how does this affect US dynamics? It would seem that the US crude oil surplus appears to be primarily domestic production driven. And our imports, while our imports increased, they increased by less than exports. And the imports from Saudi Arabia were 365,000 barrels per day. That was up 97,000 barrels per day, but it's 29% and 62% lower than the respective time period in 2019 and 18. So the discount, the price war, has not led to a significant increase in our imports, and certainly not from Saudi Arabia. Texas Railroad Commission is kind of a wild card, I think. They have a meeting tomorrow. Part of that meeting is intended to include a vote on whether or not the commission should impose pro-rationing within the state for the first time in 50 years. It's actually expected that that proposal will fail, but I thought it would be interesting to at least comment on what I think the implications are. I don't think it would really help. Texas isn't large enough globally anymore to really make that big of a difference. Their total production is less than 6% of global production, so some fractional decrease there in pro-rationing is not going to have much of a global impact. And at best, it might have a national impact, but it would mostly help non-Texas producers, because not unlike Russia's concern about OPEC plus cuts helping US shale in general, I think any price supporting result that would facilitate continued or expanded production in non-Texas jurisdictions. And that's it for me. So I will now unshare and we can come back to the group. I see Jeff is with us now too. And I'll go back to muting at this point.
Okay, well, let me introduce Jeff Curry. He is presently the global head of commodity research at Goldman Sachs. And if anybody knows what's going on, it ought to be Jeff. So we're going to get to hear from him now.
Great, thanks, Sam. Well, why don't we talk about what's going on in these markets more broadly from three different perspectives. The first is, let's talk that all up to the event that Ron just talked about, which is hitting storage capacity constraints in the mid-continent. By the way, we'd already seen Wyoming prices go negative, so that that this wasn't a surprise. The degree of it was a surprise by the positioning. Let's talk about the inflection phase that we're in right now, in which we're going to see a rebalanced market, we think, by early as June. And then let's talk about what does the outlook for the recovery look like. So starting with the how we got here, I like to point out is that oil really creates everything about social contact and globalization. It's everything from autos, airlines, cruise lines, and then it also creates globalization through ships as well as aircraft. And what we have really gone after and curtailing with social distance measuring are those two things, social contact and globalization. When we look at the impact to oil demand, it's 2.5 times the impact to GDP. So if we look at the GDP impact, it's roughly 5.3 times anything we've ever seen before. And then as a result of looking at the impact on oil demand, it's 12 times, 13 times bigger than anything we've ever seen before. So, this is unprecedented, largest shock we've ever seen in our lifetimes. Initially, if you go back to March 5th, when OPEC made a decision to pursue a market share strategy, it made a lot of sense if you thought that the demand losses would have been 5 million barrels per day. Shale's production is 7.7. They have not had the capability to undercut shale since 2012 or 13. So this was a unique opportunity. We've argued, there's only 2 times in recent history, going back to 1980, that OPEC has tried to do a persistent production cut. And they both ended in tears. And one ended in tears in 86, and it ended in tears this time. You go back to 2016 when they initiated this production cut, you've lost an enormous amount of shareholder value. We estimate 1.3 trillion because $60 was unsustainable. And then also the loss to market share of the OPEC countries runs about 220 billion per annum. So catastrophic decision in 2016. A good thing was reversing it. The problem is the demand losses started to accelerate very quickly as it spread to Italy and ultimately the United States and beyond Europe. But I think the key point is April 15th was likely the trough in demand. We think it was down somewhere around 30 plus million barrels per day. And our modeling of that to come up with that being the trough is we're using China as the prototype. And it looks to be a very good prototype here because it would have said that the global trough was somewhere around April 15th. We're clearly off the bottom. We would put that number in total lost number somewhere around 24, 25 million barrels per day. We think it will average 18 in the month of May. So it is, and you look at the Apple mobility data, all of it suggests it's improving and improving at a little bit faster rate than even what the China experience would have suggested. So that brings us up to where we were 2 weeks ago. And I think the key point here is as we went into 2 weeks ago, and you can look at the satellite data, suggests that global inventories were building somewhere around 25 million barrels per day. It's pretty consistent with that whole idea that demand was down roughly 30 million barrels per day. And if you think about, for those of you who don't follow these markets, the demand level we're starting with is 100 million barrels per day. So it's a 30% shock. Now, when we look at this in terms of thinking about how does the system accommodate the surplus, back in March, guesstimates put the total global storage capacity at 1 billion barrels. 30 million barrels per day, 30 days, you're exhausted, which is where we were. We know that in places, particularly up in the, PAD 4 up there in Canada, where it's incredibly pipeline constrained, you're running into these problems already, which is why you saw the sharp decline in prices. Now, the key is you don't really ever hit nameplate capacity. You run into traffic jams on the pipelines long before that, or other factors. And, I like to point out 08, 09, credit got you. The credit almost got us here, but the Fed stepped in and extended, unlimited QE that freed up the liquidity to keep the system going again. So, in terms of thinking about hitting that, you're probably going to run into the traffic jams at first. Just like you're running down a freeway, you get too much traffic and you grind to a halt. That's what typically creates the negative prices. Quickly, though, just following up on Ron said that what made this one very vicious, oil and commodities, you can't buy and hold like an equity or bond. They must roll. And when you roll, you're forced to sell the prompt and turn around and buy the next contract out. And what happened was you had Bank of China had an ETF. Everybody knew this was coming. We saw this in 09, the market collapse as you go into full storage because you have nobody to hand off that position to. So anybody who had a breathing heartbeat knew to roll this thing a month in advance. China was an automated system that waited right up until the day before expiration, tried to sell it, no liquidity, and that's why the market collapsed. There was prints of them getting out minus 770, 50. I think I even saw one of minus $150. So the losses were somewhere around $1.3 billion off of that day. That's a whole different discussion. I don't think it'll happen again. Everybody's learned their lesson. Everybody's rolled further out on the curve. So we're at the rebalancing point. Supply is breaching storage capacity constraints. We have to bring supply down in line with demand. So far in the US, we can estimate somewhere around 1.5 million barrels per day of production shut-ins. We estimate you need to take another 2 out in the US, and that'll probably be your trough sometime in the coming months. I'll talk about decline rates and that so forth when we talk about the recovery, but let's say we've got 10 million barrels per day of cuts coming out of OPEC. That's still another 5, because remember I said March or May will be down 18. Supply is so far down, let's say somewhere around 2, maybe 3. Then we've taken out 10 due to OPEC production cuts, because you won't get full compliance. I will say this is not an OPEC production cut. This is a Trump cut. He used a big stick with the OPEC countries about military bases. Similarly with Russia with quid pro quo on sanctions. So when we look at this, the compliance from that group he used the stick on will probably be 100%. Outside of that, my guess is if they're not forced to shut in because of logistical issues, they won't. Because the last thing you want to do is shut in for when you have the recovery. So the net of it, we probably have about 5 million barrels per day left to do, but we're getting close. Now the key here is once supply is all shut in, down in line with demand is recovering, we go into a deficit. We think that happens sometime this June. Now, the key is prices got to stay down in this $20 barrel range, because if you bring the supply back online, you'd be right back up to breaching storage capacity if big price spikes again to the downside. June could witness on a fundamental basis a negative price number, but I'm not going to cross my fingers on it, because we've talked to the producers in Houston, lots of shut-ins. And here's the key too, demand looks to be a much better recovery than what we initially expected, particularly in places, using China as the model. Now, why were we skeptical of demand recovery? Several factors that we picked up in China. One, construction and manufacturing led the way. Consumer durables lagged. Driving and gasoline are part of that. The reason why manufacturing, construction, and infrastructure led, there are activities you can do with social distancing in place. The other issue is we saw a lot of commuting demand that used to be, let's say, subways, trains. People were afraid to do that. US doesn't have a lot of trains and subways, but that was a substitution that accelerated the commuting demand. And then the other issue is you can see it in the data in China. Leisure, cinema, that kind of demand, taking kids to swim lessons, just is not there. So we thought it would lag. But any of what we're seeing so far with the Apple mobility data is that, hey, the demand does look like it is improving in the US and Europe, and actually US even faster than what it is in Europe. So the net of that is we're on a relatively positive pace. So we think prices trade in a $20 to $30 range as we go into 3Q. 4Q, once we begin to earnest inventory draws, and if you had 100% compliance on those OPEC production cuts, and you look at a demand recovery similar to China, we would likely see inventories normalized by the end of the fourth quarter. We don't think you'll get the full compliance outside of the ones where Trump used a stick on, which means you're probably normalized by the middle of next year. Now that's key, because when we start to look at the situation that people forget, oil is an organic deposit. It has natural decline rates. Normally they would run 5 to 6%. Investment has collapsed. You're doing damage to the wells as you shut in. We're using something closer to 9% right now, which means you even have Exxon at this point has shut in CapEx, which means that the decline rates are likely to set in rather quickly. And as they set in, we think these inventories are going to, draws are going to accelerate as we move into third and fourth quarter of next year. You're teeing yourself up for a very, I'm going to call it 99 type price spike. Last time we really breached storage capacity and had widespread shutdowns. Because in that environment, you have prices go from $8 a barrel to $40 a barrel in 18 months. Very similar dynamic that we think is going to play out here. And I think the key issue is you need to get capital to the market by the time you get to fourth quarter next year. That's going to be really hard. No investor wants to go back to this space. I like to point out, I can't get any portfolio manager to take a call on anything in oil, gas, or commodities. They don't want to hear about it. Then you have the ESG, environmental issues overlaid on top of that will hamstring the European integrateds from making these investments. And then you got to deal with bankruptcies, and then you have to deal with the Permian in that area. We're going to have to see large-scale consolidation. So I think it's going to be a real difficult time when we start to look out next year in terms of getting the capital together, grow the supply base, and rebalance this market. So, but I think the key message here, more downside risk near term. I think I don't think you're going to see a repeat on the June expiry because too many people adjusted it. They've lived through it. But it could happen elsewhere in the US or elsewhere in the world. We think a balanced market by June, inventories begin to draw, and we think it'll be accelerated by damage done to the wells during the shut-ins, the lack of capital to redrill, and then the big one is natural decline rates. So in terms of looking at where we end up in fourth quarter of next year, we could easily be back on a Brent basis, $65, $70 a barrel, WTI 65. Right now, the back end is trading in that $30 range, so we see a lot of upside. I wouldn't touch August or September because I think you can still do damage there, but I'd start thinking about the back end of that forward curve. I'll leave it at that.
Well, thank you very much, Jeff. We appreciate that overview. It's always a bit overwhelming to me. I'm going to talk a little bit now about what the implications of all of this have been for field prices, both in terms of the NYMEX price on the 20th of April, and take a look at how some of that pricing has changed. So if I may, I'm going to, I need to switch over here. Oh, darn. I need to switch to my share screen and then bring my PowerPoint up. Okay. I think Jeff just did a pretty good, Jeff and Ron have done a good job of explaining why oil demand resulted in negative pricing. I'm not going to cover that, but I would point out that the EIA has collected data and it gives us some idea of the specifics of North America, which are worth taking a look at. Their last report, which was on April 29th, 2020, had overall petroleum product down about 22%. But importantly, gasoline was down around 36%. But note that gasoline supplied, this is not an exact estimation of demand, but it's the closest thing we have in the short term, was down 36.5%, but it had improved from the previous 2 weeks. Jet fuel also was down around 60% and also a slight improvement from the two previous weeks. Heating oil or diesel was down around 25%, but that's to be expected because that's seasonal. So in other words, Jeff's analysis that we may have reached bottom in mid-April does appear about correct for North America based on these EIA data. I'd like to talk about the impact of oil futures prices on field prices. Crude oil prices, and I'll give you a little background on this before I get to the specifics, but crude oil prices vary depending on quality of location, on the quality and location of the stream. Historically, sales prices were indexes to prices posted by companies actively buying crude oil. Posted prices in turn were based on a benchmark crude oil price depicting the general market. I might comment here that despite the fact that the posting system is a very old system, it still is relied on in a lot of contract sales. So out in the field, you may see postings being the governing price that determines what a buyer will have to pay and what a producer receives. For years, the benchmark price was Arabian Light, either its official sales price or spot prices cited by the trade press. However, since the development of NYMEX's crude oil futures market, its prices have played an increasingly important role in setting U.S. field prices in the physical market. Specifically, the NYMEX prompt price for West Texas Intermediate at Cushing, Oklahoma, is the primary basis of most U.S. indices, impacting prices for most sales contracts. This is important because the price extends far beyond Cushing, in other words. In most cases, U.S. trade press prices also follow the NYMEX prompt price for WTI at Cushing, with adjustments for quality, location, and local conditions. Local conditions is something I've added recently and had never really thought about, but basically that means if you've got storage at or near an oil field or close by at a junction, that's going to help moderate prices at that specific point, where it may not moderate them at Cushing. On April 20th, the prompt price for NYMEX contract for deliveries of WTI closed at minus $37.63, impacting prices of up to 11 million barrels of crude oil. That's all the crude oil that was developed in mid-continent. I'll show you a couple of price graphics here to give you an idea. The first is the Brent price as reported by Reuters. This price basically is a good international marker. Brent is a light sweet crude oil that's delivered into Europe. Is produced in the North Sea. Below it, we see the WTI spot price, once again reported by Reuters, and looking at what prices in the field look like, we see that the premium price, as reported by Plains All American Pipeline in their postings, is once again below the WTI price. The North Dakota price, this first purchase price, is also below the price of WTI at Cushing. So the further you get out in the field, the more likely you're going to have a fairly substantial discount in prices. When we take a look at the similar prices during the period of April, what we see is, once again, the Brent prompt price from the Intercontinental Exchange is at between $20 and $30, a little bit above 30 on times. The NYMEX prompt more or less followed it lower, but did follow it up until April 20th, and then it went way down. The WTI spot price from Reuters reported a very similar price, and as did the WTI price in Permian, again reported or posted by Plains All American Pipeline, and offshore and Louisiana offshore oil as reported, as posted by Phillips. So you get an idea of how the impact affected all the other field prices in the mid-continent. And to illustrate this further, I've pulled a Shell posting out for April 20th, and you'll see that every price on their postings is at or below negative $40. The exception being the California prices. California and Alaska have separate pricing structures because they are not interconnected with the rest of the continent. Not everything went down in the same way that NYMEX prices went down on the 20th of April. Crude oil, all postings companies reviewed appeared to have accepted the NYMEX prices more or less as they were, with the usual differentials. On the other hand, the trade press did try to capture some of the individual pricing behavior in specific locations. For example, Argus Media reported the following. You'll note that WTI at Houston and WTI at Midlands had previous price differential of $3.50 and $3.75. The differential went up on April 20th to $16.50, but you still ended up with a negative price of over $21 for WTI in the Houston area, even though it was already delivered nearly to a tidewater. So the negative crude oil pricing of NYMEX, in conclusion, did have a serious impact on field pricing through the indexing structure that is used for almost all sales in the North American market. Next, we will have a presentation by Les Deman. Les has been a long time associate of Les Deman in energy consulting. He's worked for Shell and a variety of other companies. He's going to talk about North American natural gas. So I'll turn it over to you, Les.
All right, let me see if I can get to my full screen mode over here. Slideshow, one. Okay, great. So my focus is on North American natural gas. Thank you, Sam. You know, we're on oil side, we're talking about V recoveries and so on. Not too sure what we're going to see in natural gas, but what I'd like to do is kind of go over what some of the short-term forecasts are and some of the implications long-term. So this first chart one, I'm not going to spend much time on, one that just came out about a week ago from the EIA, Energy Information Administration. It shows the 2019 flows, natural gas, inflows, outflows, sort of like a sausage. Kind of
Les, we're not seeing your slides.
Okay, all right, thank you. I'm seeing them. Let's see if I can figure this out.
Les, if you bring your mouse down toward the end of your screen, you'll see a share screen option in green.
How about now?
Beautiful.
All right, are we on the same page? Okay, sorry about that. Let me go to slideshow. Well, in any case, I'll keep it. This sausage, as I indicated, is what the 2019 flows are. Point I want to make over here is that at least for 2020 and possibly 2021, most of the sausage is going to be smaller. So we're going to see smaller inflows and we're going to see smaller outflows. What this chart over here shows is the first look at the coronavirus impact. And by first look, the benchmark that we typically use on the natural gas side is the short-term energy outlook published every month by the EIA or the STEO. So you can see that this chart, by the way, this was published, I believe it was April 6th. So it was kind of a first look, and this was the outlook for changes, year-over-year changes, 2020 versus 2019. And you can see that, for example, that their forecast for a GDP first quarter was up. We certainly got information last week that it was down year over year. So this was the kind of the first guesstimate, and basically that's what it was. And so there was a lot of information that nobody had. So the forecast was a recession with a third quarter trough, industrial production lagging with a fourth quarter trough, U.S. demand falling in almost every quarter on a weather-adjusted basis, and U.S. gas production declines accelerating in the third quarter of this year. And you know, the question, I guess, is from the oil side, it looks like we've seen a trough. Not sure is it going to be V-shaped, but certainly from my perspective, a lot of other economists question is, are we looking at a V-shaped recovery or a U-shaped one? So this next slide is my agenda. We're certainly rewriting the playbook, at least in my estimation. This is like nothing we've ever seen or I've ever seen. I've been in this industry over 40 years, and I know that my models, and I'm sure most other models, are not equipped to kind of take stock of an impact like this. So I'm going to go over what at least I think some of the implications are, where I have at least some good insights, what I don't, because there's a lot we don't know. Looking first on demand, short, medium, long, then on the supply, and then on market psychology. By that I mean on price. So let's take a quick look on gas demand. I can probably talk for a long time on all of these. So on the residential side, gas demand is a function of heating degree days, how cold, how warm it is, the use in intensity, which I'll talk about, gas price, technology, and policy. Short term, we've seen higher demand. We have more people working at home. We have schooling from home, and therefore people are using their space heaters, water heaters, etc. More. So short term, certainly that's a higher demand. Medium term, obviously there's a lot of uncertainties, but we see a continuation of work from home, school from home, and if so, for how long. So that's obviously the uncertainty there. Long term, there are probably some secondary impacts, climate change, fossil fuel use. We're seeing questions raised, will people move away from cities? If that's the case, are they going to have larger homes, more floor space? And of course, on the policy side, will this have any impact longer term on gas policy? For those of you don't know, I live in California. Several of the local cities have put a moratorium on new gas hookups. Natural gas, of course, New York is talking about that too. That can certainly have a longer term impact. Commercial side, larger impact. Certainly, we've seen a lot of closures, reduction in retail space, malls closed, and so on. We've seen a lower demand certainly on that last couple of months. How much of that will return? Will malls, all of the U.S. open? Will they open partially? Will retail return? I'm sure a lot of restaurants will probably not open. Other stores will not open too. So that will have certainly an impact down the road. Again, home office use versus central office. That'll have an impact. More home office use. A lot of commercial buildings will need to fully heat and use energy. Same thing with schools. And of course, long term, there's going to be a more shift to purchases from home. Will that have impact on malls and others, so on. So certainly there's an impact there. Industrial side, we've seen a lot of manufacturing closures, so there's certainly a lower demand on that. And how long until that returns? I think medium term, the question is, will we have any changes in policy? Will U.S. manufacturing become more competitive down the road? Long term, certainly geopolitics. Will we have more insourcing of manufacturing and other policies? So there's certainly some factors that will come to play both intermediate and longer term. So next big sector, in fact, the largest consuming sector of gas size is the electric generation, plant closures, so on, aluminum, steel, chemicals. We've seen less demand the last couple of months. Short term, by short term, the rest of this year, we're going to see lower gas prices or higher gas prices. I'll hit that in a little while. Obviously, if we see lower gas prices once the manufacturing returns, we're going to see higher demand, or vice versa. Medium term, question is also on price. We're going to have higher or lower prices, and that's going to have an impact on plant dispatch, whether we use coal or natural gas. I think the current outlook is that gas, at least so far, has been cheap enough that it'll displace coal. So we see an increase in gas use if gas prices don't jump up very high. Longer term, again, policy implications, renewable fuels, and what have you. Same thing for manufacturing demand for electricity, insourcing, outsourcing, new supply chain. On the demand side, I also talk about LNG here. LNG has certainly been a very big factor. It's certainly taken away a lot of the surplus that U.S. gas has had. We've certainly seen lower exports for LNG. There are about 20, 30 cargoes that U.S. LNG exports that were canceled in June. And the real question is, how quick is demand going to come back in Asia? I know Europe has an issue that they're oversupplied of natural gas. So that's one source of LNG that's at least not going to be available for several months. Again, medium term, get our price versus others. There's certainly a less optimistic outlook for LNG because I think a lot of demand might be lost for longer term. And the question is, what will U.S. gas prices do? So again, that's a big factor there. We're going to hit supply very quickly over here. This is the kind of the supply outlook before and after. The kind of the blue line, which is short term, and the green line was a forecast late last year. And that was based upon $3 per million BTU for gas and about $60 for oil. And that certainly provided a rosy picture going forward. Also, we saw falling gas prices in 2019 and first part of 2020. That kind of had a negative impact. It soured gas drilling, but of course, oil at $50 to $60 was positive for associated gas. So that orange line you see down there, this was the short-term energy outlook come in April. So they certainly changed from the January, the blue, and of course from the green line over there. The chart on the right shows that where most of the associated gas comes from, gas associated with oil production. In early 2020, the Permian was producing over 12 million barrels per day. You just heard that oil production will be going down. That may have an impact on gas production from the Permian too. And at least at the start this year, associated gas was about 20% of total gas production. This has changed because now we see a 12-month strip for WTI of 26, gas of $2.60, and none of this is very economic as far as increasing production going down the road. So quickly on supply, short term for associated gas, certainly a flat to declining trend. How much? We'll just have to wait to see. Medium term, question is,
sorry to interrupt, but we do want to leave time for questions. So if you could wrap it up quickly, appreciate it.
I will that. So I will. I'm going to make these copies available down the road. But anyway, short term, we see declining associated, declining gas, and on imports for both. We also supply. We see not much change there. Quickly on price, which I think a lot of people are certainly interested in. I have some of the same charts for gas as you had in oil. You can see that first chart shows what the NYMEX was forecasting in September. The blue line, then you can see what it was forecasting in December. The green line was on March 15th, kind of when the virus hit everybody's mindset and current. What's interesting is that we see prices have gone up from what they were before. The chart on the right shows where the average prices were back last year. Now the price for 21 is much higher. People, these the market is a lot more excited about lower production, which of course means higher price. But what's interesting, if you go 23 and 24, market psychology has changed to lower prices. Last chart over here, well, next to last chart, won't go into this one, but one more, since I talked about North America, Canada, Mexico, obviously like oil, if GDP declines, gas demand is going to go down too. There's a large impact from Canada, given that about 30% of their gas was used for oil sands, and oil sands are not economic. So that's a negative impact there. Of course, less gas demand in Canada might be more exports to the U.S. Mexico also a very big factor. Oil is very big, important in their economic growth. Lower oil prices means lower GDP. So that's going to have an impact there too. So these charts kind of hit some of those highlights. And I guess we need about 10 minutes for Q&A, so I will end it right here. Thank you.
Thank you, Les. Great. Well, we do have some questions. The first question is for Jeff, and and for Jeff, can you speak more from Mark Finley? Can you speak more about the risk of damage to shut-in wells?
I think there's two sources of risk. One is just the lack of CapEx that's going to cause the decline rates to begin to set in particular, like you look at shale, where the initial year decline rates can be as high as 70% in some cases. So I think that would be the first and foremost damage that you're going to do is sharp decline rates. In fact, that's enough to create a real serious problem into next year. The second is the damage that you're going to do to the older wells. Now, if you were a social planner, you would shut in all of the Middle East production and all the deep water offshore platforms, because you don't build $30 billion platforms on small wells. The problem is none of that's needs to be shut in. In fact, Saudi would not have shut in if they didn't have to. What's going to be forced to be shut in is what's sitting at the end of very long pipelines, which typically to be more mature fields, small reservoirs, large water cuts, and you could do permanent damage. That could be upwards of 1 million barrels per day, most likely in places like Russia, US, Canada, and Colombia. And then the third issue I think that's going to be damaging to wells are supply chain effects. Completion materials coming out of Italy. It's just going to take time, 4 or 6 months before you really can get up. I like to point out demand. You just walk out to your garage, get in your car, and start driving. So the supply is going to require a lot of investment, and that's the biggest problem I think is no capital access to be able to do this.
We have another question here. Ron, this looks like one down your alley. Do you think Cushing is a good benchmark for NYMEX futures? From Ellis Answar. Oh, I didn't pronounce that correctly, but anyway, Ron, what do you think?
Well, I mean, it's been the benchmark since the beginning of the contract. So, I mean, I think that historically it's worked very well, and we're facing really unprecedented times. So I think it would be a mistake for people to think that somehow we should be seeing what might be considered normal activity in the marketplace when we have a completely non-normal world that we're operating in. So I think that, as I said, I think that the response that we got, even there was a negative price that most people aren't familiar with, that was a rational economic outcome of the imbalance that was there. So I actually would argue that the NYMEX contract and the trading that happened around it was a rational outcome. And the point that Jeff made about China being in there, I wasn't aware of that particular aspect. I just knew that the 108,000 contracts at the beginning of trade on the morning of the 20th was way out of line for what is normally happening at that point. So again, as Jeff noted, I think the market has learned and adjusted already to those unusual circumstances. So I don't see any particular reason why we should be thinking about moving away from Cushing as the base for that contract.
there's another interesting question here. I don't know if you can answer this, Jeff, but do you have it's from Sean Mew. Do you have a sense of how much the volume traded on April 20th is from the Bank of China, particularly in the last hour?
Almost all of it. Yeah, there may have been another ETF, but the one, I mean, we know that the total losses, it ranks up there with like Mattel Gesellschaft or Sumitomo on copper. It's going to go down in the annals of finance of one of the largest train wrecks ever. Unfortunately, the Chinese, the Bank of China is going to, when people bought that ETF, they thought that they could only lose their principal. They got bills for the loss from below that, and it was a lot more than the close of -36, because going in that last hour, as you saw, there were big prints. And I think it just goes to ETFs. Can I just pound the table to everybody on this thing? You don't own oil. You own the rolling front month contract. People think they own oil. Gold, you really own gold. And the reason why you can put all the gold's ETF in your front living room, because gold is very dense. And so like 150 billion. Oil, it would take 55 VLCs to store it, which is an impossibility. It's worth 9 billion. So let me just remind you, gold, 120 billion in your front living room, 55 VLCCs for $9 billion. You'll never do a physical ETF in oil, but the world thinks that they are. They own it. They get destroyed. Do not buy it. Let me pound on the table. Run from that product. The problem is a lot of people still think they own oil and they get killed. It happened in 09, and it happens again, and it'll probably happen in the next cycle.
Okay, well, another question from Ellis, Jeff. What can you tell trade financiers who concentrate on refined petroleum products?
I think, it's not, I think you alluded at this when you were looking at the gasoline versus diesel is, out talking to our clients, naphtha and the petchems are doing relatively well right now. Just because you think about it's more manufacturing leads the recovery like it did in China. Diesel, because you got Amazons and everything else going, delivering. So the diesel segment and the naphtha and petchem segment, which will include the LPGs, are doing relatively well. It's really gasoline and jet are the ones that are getting destroyed. And so you're going to be caught in a situation where I think these refiners they've swung those yields as far as they possibly can. But I would tend to think that it's going to be a struggle on the recovery to be able to match that balance. The jet is going to be the longest one. In fact, if you look at the demand losses, you can say 8 million barrels per day of commuting demand, 8 million barrels per day of jet demand is lost. The 8 million of commuting, China got it almost all back. We think some of that's because people won't get down in the subways. And I think, so let's say you lose a little bit, maybe you lose 1.6 million barrels per day. That goes 4 days as opposed to 5. The jet, I don't think business, we're all sitting there on the Zoom, it works fine. I don't think that may be a permanent structural shift. It could be as much as 3 million barrels per day lost on a permanent basis, which means that jet lag is going to be really hard to cope with from a refining perspective.
Okay, one final question here, again for Jeff from Henry Dower. What are the chances of the U.S. Government stepping in to help the oil and gas industry?
I think, you look at the failure of the Texas Railroad Commission thus far, there was a lot of opposition because a lot of players want the free market to take for it. If you're a small player, you actually like the quotas because it helps you out. You're a big player like an Exxon, you don't want it. The big players were the dominant players here. They would oppose it and probably put it into any litigation because they're set to clean up here. The consolidation is going to be massive. Part of the reason why nobody likes this sector is that there's been too much coddling of producers with very poor returns. They should not have been producing oil. And I think a lot of what we're going to see here is a consolidation that's going to create more efficiencies and a better allocation of capital and better returns in the sector. The big guys were opposed to this. If you go down the options, the only option you could have done is make a foreigner cut production. Trump tried that and they got that. Everything else, it creates a misallocation of capital inside the US. So I would say it's a pretty low probability at this point, particularly since it's just too late. But I wouldn't, I think just going down, you can't really do a tariff because Saudi and Russia don't really import that much into the US. And you really can't do a price floor because that creates misallocations. They were talking about compensating drillers, leaving it in the ground. That's the only one that really would make sense because you're treating the ground as a storage capacity. But the net of it, I just don't see the politics of it lining up. And we go back to our view, the free market is probably the best way to deal with this.
Okay, does Ron or Les, do you have a comment here? Very briefly.
Well, the one thing that I would throw out there, as Jeff was just saying, we don't import that much really from Saudi Arabia. The 365,000 barrels a day that came in from Saudi isn't even enough to completely fill its own refinery at Port Arthur, which can do 600,000 barrels per day. So we're definitely not getting swamped with oil coming from the outside as a result of the price war.
My comment is, if you like negative prices in oil, smile when you see natural gas. If demand continues to be down, we're going to see a lot of gas trying to go into storage. And where there's no storage, we see negative prices in natural gas. We see those quite often relative to oil. So look for negative gas prices, natural gas prices down the road.
Well, I want to thank all the panelists very much, and I appreciate you speaking today. I'm going to turn it back to Dave, but I also thought about this a little after. It is, after all, the 4th of May, and I guess with apologies to Disney, may the force be with you.
USAE wishes to thank Dr. Sam Van Vactor and our distinguished panelists for an outstanding webinar. I know I personally learned a lot, and I thank you very, very much. This webinar will be available on USAE's website for future download. If you're not already a member of USAE, we encourage you to join by visiting www.usae.org. Thank you once again, and I officially close this webinar.